Dan, I was going to ask you, some of the things that we've seen recently as far as lending, have you noticed an uptick in people that have changed their mind about moving forward due to the interest rates?
Yeah, I definitely have. And I'm reminding them that this is the opportunity to buy. You know, we've seen in 2020 and 2021, just like the sheer demand out there with, 15, 20 offers on every house, 20 or 30 grand in cash over the asking price. I mean, I saw like 80, 90 grand at, a couple times too, which is insane.
Did you ever ask yourself where they come up with all this money?
Where in the world are they getting this?
I'm just saying, where are you parking this? Because, we have to document every dollar that comes in that exceeds 25% of their income, right?
Yeah. So and I'm like,
where are you parking this money and how are you getting it?
I'm like, they must be, COVID must be really good for them, I guess. I was just kind of surprised that all these people had all this money all of a sudden, and so we would see a lot of that stuff. But, if you think about it now is the time to buy, because you're going to avoid all of that stuff. Because, realistically, with the rates being where they are, people are paying maybe $150, $200 more a month than they would be if rates were lower, right? Whatever that lower rate is. But generally speaking, $150 to $200 a month. That's what, like $3,500 for 2 years, basically. Like, all these people are going to be refinancing within the next year or two anyway, when the rates come back down, when the recession hits, because it always does. It's always lower in a recession. So $3,500 to $4,000 or whatever overspent on rates, right? But the thing is they can buy now and avoid paying 20 or 30 grand in cash over, not getting any concessions, not getting an FHA loan through, I'll tell you that, or not getting the seller to repair anything. There's all kinds of factors that they're going to avoid. So now is the time to buy, when the sellers are more desperate, sellers are more willing to work with you, sellers are eager to sell and they can't because the houses are sitting longer. Like, now's the time to take advantage of that. So I keep telling people, now's the time for you to buy. I mean, now, go now. Even if the rates are higher, go for it now.
So are you finding that in certain price points, though, there's a bit more competition?
Yeah, when it's lower, for sure. Yeah. So, those are still moving, and those are still going to be pretty close to what you're paying in rent, because rent's really high right now. So, those are going to be still there. Now, the thing is, when you get up to the higher price points, well, those are, people aren't necessarily renting that much for like $5,000 a month plus, like that's pretty hefty rent.
It is.
So, we're not
seeing can afford a $5,000 monthly rent, obviously is not marginal, right?
Yeah.
So one of the things that I think that we should bring up are how these loan limit changes affect the buying power, especially people in our area. So you and I are both in Kern County in California. We're considered to be the fourth most affordable market in the state, which means that we have a lot of people coming to this area from out of town areas and really not significantly taking a pay cut. So I've seen RNs come from Los Angeles coming here, literally not losing any money. And then some people that are coming over for management positions or even mid-level things that they're transitioning with companies where the cost of living adjustment is not dramatic. It is different. Don't get me wrong. I can't say every industry has that kind of experience, but we're a very affordable market. And for people that say, well, there's no city life, you're an hour and a half from LA. Let's be perfect.
You know what I tell people? What I tell people is we are a one-horse town.
Okay, explain
why. RPF Chang's has one horse in front of it instead of two. We still have a PF Chang's.
Yeah.
We still, we can still go eat PF Chang's. It's just a little smaller than the one in LA. Okay.
Yeah.
And really the only one that I could really think of that's not here, that's a big chain, is like a Cheesecake Factory.
Well, weren't they supposed to be building one?
Well, that's what I thought. And I'm really surprised they haven't started just doing cheesecake over DoorDash between you and I.
Okay, so I was just talking to an attorney at lunch today, and you know what he said? He said that they are building a second Chick-fil-A.
They are.
Yeah. See, so
Rosedale
that's
Highway.
what I hear, and the crazy part is if you and I both owned a Chick-fil-A each, we probably would not have a life, number one, because we'd be busy all the time, but we would get Sundays off.
We would. That's correct. We'd have a whole bunch of very kind employees to work with.
Yeah, very much so. But locally speaking, one of the things that we talked about at lunch, and I want to bring it up, it's kind of important, is the fact that the thing that always concerns me, and it's something we should be looking for, is unemployment. If we see rampant unemployment increase, I think that we're going to see a change in our market.
Yep.
If we can stabilize employment here, I think we'll see stable economy. So projections from I believe the economist Yoon from National Association of Realtors actually said that we're still expecting a 3 to 5% appreciation annualized. And locally speaking, between 2020 and present, I actually have emails directly from Gary Crabtree that I asked these questions, and he said our net appreciation has been over 40%. So if we have a market correction, let's just say we lose 30%, you're still at 10%. Which is crazy because if you think about it, if it was 2 to 3% per year, you didn't really lose anything. But equity is just a number. It's, what you owe versus what it's worth. And if that value goes up and down, it's like anything in your stock portfolio, it's going to have its gyrations. Yep. But equity is only a number until acted upon. Right? Yep. So right. I always advise clients, just listen, when you buy a house, especially your primary residence, don't think of it as a flip. You need to think of it as it's housing your family, it's taking care of your kids, it's putting you in a school district that you want to be in. It's providing you with stability. Because I don't know if you ran across this, but I ran across this. I had clients that were desperate to try to pre-qualify because the house that they were renting, the owner decided to sell.
Yeah. Yep, I got one of those right now too.
And you're emotionally tied to the fact that you can't do anything for them because there's not a lot that we have control over. Yep. Because we didn't have the history that they had credit-wise to get us to this point, yet we're asked to work with the ingredients to make a pie. That makes any sense, right?
Yeah, right, exactly.
So it tears my heart out because I want to help these people, right? Our intention is to serve others, to give them an opportunity to see what may be possible. And if they're not ready now, that's okay. If we can coach them, get them ready, whether it be credit, getting their debts down, putting them in a better financial situation, we want to do that sooner than later.
Well, also, and this is why we're friends, Alan. This is why we're friends, is because you and I have the same heart for people.
Yeah.
And we actually care genuinely about being an advocate for people.
Yeah. And I think that we're pulling back that veil that people don't see on the backside and trying to make it simple, right? Because as hard as this is, audience, to understand, the bank has the money, you don't. You're asking them for money. We're trying to help you get that money, but you got to work with us, right? Don't hide anything. Be transparent. Allow us an opportunity to get the data, and we will sort through what's important. Yep. And at that point, we'll present the best foot forward on the information that's necessary because we don't need to give them everything. Let's be perfectly honest. How many times have you received extra bank statements on accounts that were like, well, I don't need that. What? Get it.
Oh, yeah. I clear it all out with the DU.
I'm glad you have it.
Oh, yeah.
Keep it for a rainy day. Protect your family. Have a safety net, right? Yep. And always think about what could potentially happen, but don't dwell on it. Just say, here's the plan. And if you build a strong foundation, your pre-approval, your loan should move smoothly. The only issue you worry about typically is your appraisal, right? And the condition of the subject property. I would like to say a bank's not going to lend on a car up on blocks, right? So we want to make sure the collateral meets the requirements. But then we're also in advisorship going to offer them the differences between loan types too.
Yeah.
Right. So we've talked about this in many, many ways, but government insured loans, VA, FHA, USDA have a different standard. And very specifically, it's health and safety items. And sometimes they're kind of like, kind of a cut and then throwing salt in the wound. It's like, okay, so you have peeling paint. And conservatively speaking, yes, it should be fixed, but we can't move forward without these things. So if we have a better idea of what you're looking at and you qualify for both FHA as well as conventional, we may recommend you go over one loan type versus the other.
Yeah, absolutely.
So let's
a lot of factors that go into picking whichever loan you're going to be in.
Yeah.
DTI is a big one. Monthly payment is a big one.
Yeah. So
the status of the property, like you said, I mean, that's why you get with a loan officer anyway, is to help. We help guide you and put you into the right loan. That's again another reason why you don't ask about the interest rates necessarily, because it all depends on where you go, because there's so many factors.
Yes, and it's very specific to each individual person, and I say that being very serious. You cannot treat everyone like a nail just because you're a hammer, right? So
it's not
part of our
responsibility.
What's that?
It's not push button get mortgage.
Yes. Oh man. It drives me crazy when it goes, well, I could just go online. I'm like,
yeah,
that's great.
It's push, it's push send to call Alan or Dan. And
there you go. It really is.
Local advice.
When they start to talk to us, I think they notice a difference. There is a different level of not only concern for their personal condition, but we're local. I mean, we're in the community. We see you. We want to give you a handshake or a hug. Not, oh my gosh, there they are, right? And we're not hiding behind the phone. We're not an email that will never get responded to. We're actually there to serve you guys. So that's a big distinction. And I think it's sometimes not thought about enough because we are a consumer, driven.
Well, and, I'll see you at the Condors game. You know what I mean?
There you go. Absolutely. So what I'm trying to pull up right now is the LLPA matrix, and I want you to go over some of the details here. I'll pull it up, but I'll let you kind of talk about it. So let's jump right into it. So what I have is the purchase money LLPA page, and I'll share that real quick. All right, Dan, you can see that, right?
Almost. Still thinking.
Almost. Let me blow it up. Okay.
There we go.
So it will become much clearer once we do editing. But what I want you to explain to the viewers here is what we're actually looking at.
Yeah. So what we're looking at is in my words would be some risk alleviation from Fannie and Freddie. So basically, they are trying to turn the faucet off on higher loan to value loans and higher debt to income ratios. So the people that are kind of at the edge. So in other words, the people that are putting as little down as possible and the people that have as high of a debt to income ratio as they can make happen, they're trying to slow the flow of those coming in. I think they're probably worried a little bit about potentially a market softening, like not really going down hard. I don't think that that's going to happen because of supply and demand, surely. But having a little bit of softening, they don't want to see people getting upside down on or underwater, on their mortgage, in the first year or something like that. So they're kind of trying to slow the flow on those a little bit, make it not as desirable. And then not only that, with the debt to income ratios, they're trying to do the same thing where they're trying to keep those a little less desirable as well. Maybe get people to try to buy a little less house potentially.
So let's jump into that. I'll slide down here and you'll see that. So this is a new feature, not something we're overly excited about, but it's right here where it says debt to income ratios exceeding 40%. I can't tell you the number of times that I've talked to real estate agents and other people. It's like, oh yeah, I'm pre-qualified. Great. And then you find out that they're at 45%. And that's where they started. And I like to say it's like playing with fire. If you're at 45% and you have a property tax bill that's higher than expected, or homeowner's insurance that pushes you over the edge, or hey, had a student loan that just got added, but we had to do a credit refresh, and all of a sudden we have this new student loan.
Yeah, no.
Anything can push you over. It really can.
No safety nets left.
Yeah. So this is not the safest way, but unfortunately, with the rising prices that we've seen, the higher, cost to live, inflation, we've hit somewhat of a glass ceiling, right? It's like, it's not that they can't qualify for something, just do they qualify for enough in the market, right? And I asked the question, you can live or you can live to make your mortgage payment, right? So I try to tell them there is balance here.
You can be house poor or you can actually have a vacation every so often.
Yeah. And basically for the viewers here, what this is showing us is that if you look at this top grid here in the blue, the baby blue, what it's showing you is how much money down. So at 95%, you'd be putting 5% down. Then the next bandwidth, if you will, be 95 down to 90, which is a 10%, 7, 8, 9, all the way down to 10%, going all the way down to putting down 70%. And you'll notice that the only point where there's no adjustment to the cost factor of the loan is at 40% down, which is crazy. So this is only if your debt to income ratio exceeds 40%, meaning the amount of money going out for housing expense for the mortgage and any other debts that you on credit exceed 40%. Now, you will notice that its max cost factor is 0.375, but that's $375 per 100,000 finance. So it's real money. So if you're buying a $200,000 house, I mean, you're almost $700 more expensive just to obtain the same loan. And that's only if your debt to income ratio is over 40%. So I'll give you a real life example. I had a client that the number of student loans that they had, and using 1% qualifying rate because they didn't have an income-driven repayment plan, put me at 41%. And I was like pulling my hair out going, gosh, and now I have to apply it. Yeah. So
Yeah.
I asked them, I said, you're selling a house. Had you thought about paying this vehicle off? Oh, yeah, we're going to pay it off. I was like, great. So we're going to pay it through escrow. So it's a $643 payment on that truck, but he only owes 17 grand. So beautiful.
Yeah.
So now his debt ratio is at 36. So we averted crisis based off of just having a little bit more data. And this is kind of stuff I'm talking about, Dan, is that I don't think a lot of people know how valuable your loan officer can be in coaching you to get in the right position to make good moves. Right.
Yeah. We help you step around landmines that you don't even know are there.
Well, I'd like to say this. It's like, I've stepped in it. It sucks. Don't do it.
Yeah. Yeah. Right. Yep.
So real quickly, let's talk about some loan types and some loan limits in Kern County. Now, these are all for single family residents. So for a single family residence being purchased using FHA financing, the maximum loan amount is $472,030. Yeah. And that is a tremendous amount of house.
That means, if you're doing 3.5% down, then you could buy basically a $490,000 house FHA.
Yeah, majority of the houses in Kern County will qualify for that, which is just spectacular. Really, really helpful. Yeah. And then when you go in the conventional realm, goodness, I personally don't want to spend this much money, but $726,200 for a loan size and staying below the jumbo limit, which it's a tremendous amount of house in our area. So, and that comes with a 3% down if you're a first-time home buyer, if you qualify and want to use that.
Think about that, 3% down on over $700,000.
Yeah, but again, we can't create inventory, but if the right match between the borrower and the house is there, I'm sure there's plenty of agents who'd love to help them purchase a $60,000 property or something. So,
yes, sir.
Good deal. Well, let's go ahead and talk about the importance of transparency in this process. I know I mentioned it earlier, but when you're talking to a buyer, run me through what a typical conversation would be in your, as I would call, discovery call. Or
absolutely. Yeah. I just remind people that I'm their advocate. My job is to take them to the lender because I'm a broker, right? So I take them to the lender. So I'm like, I need to know everything that's going on with you so that I can take you to the lender in the right way with a nice pretty bow on top, put you in the right box with a nice pretty bow on top. Right. So that's what I always say to people is I need to know everything that's going on. I want to be in your headspace. I want to know what you're thinking, what you want, what you're trying to accomplish so that I can come alongside you so that I can tell you what I would do if I was you, knowing what I know. So that's really where I try to be with people. And I've found that the people that just follow my lead are the happiest at the end. Right. So I had a client early in my career and I'll never forget it. Okay. I had a client earlier in my career. I was working with a rather prominent agent in town. You would know him, Alan, but I won't name drop. But a rather prominent agent that I was very excited to be starting working with. And he was double-ended on a deal, right? So he was the listing agent and the buyer's agent. So he had brought the buyer to his listing. And I worked with this gentleman, the borrower, for quite a while, getting him pre-qualified and all that kind of stuff. And then he's in, we're in escrow. Great. I send the guy requests, hey, I need this thing and I need this thing, and this thing wouldn't hear a peep for 4 or 5 days.
Wow.
Couldn't find him, couldn't get a response to a text, anything. Right. Uh-huh. And then I would finally get something, like he would drop by the office and drop off a piece of paper and then leave. Right. And it's like 1 of 6 pages of a bank statement.
Oh, it drives you crazy.
And I'm like, okay, so anyway, long story short, I'll cut to the point. We get all the way to the end and it's been drawn out. It's ugly. The agent's freaking out because he's about to lose a double-ended deal. He's a newer agent. This is a big deal for a newer agent to have a double-ended deal, right? And it's drawing on, and I can't get this guy to perform, right? I'm like, what do I need to do to get this guy's attention, right? Finally, it closes, but everybody's mad, myself included. Everybody's mad. Anyway, it closes. I call the client. I'm like, hey, because I know you never burn a bridge, right, in this business, right? You never burn a bridge. So I call the client. I'm like, hey, thank you for your business. Appreciate working with you. Look forward to working with you again in the future, et cetera, yada, yada. The guy admits to me over the phone, man, you know what? Next time I should probably just give you what you asked for. He's like, yeah, I don't know. I just felt like, for a loan or whatever, because it's a bank, I just like I should try to give them as little as possible. Oh, dude, you just did that to all of us for 45 days. Come on. Like, we're trying to help you.
Yeah. And I think that, that's,
I mean, just be as responsive as you possibly can. Provide the paperwork, because believe me, Alan, you can attest to this. We are not asking for anything we don't need.
No.
Because I would much rather follow the path of least resistance
Yes.
all day long.
Yeah.
Just give me what I need. I won't ask unless I feel like we need it. Because trust me, I fight with underwriters all the time to alleviate me having to ask for things from you.
Sure.
So anyway, that's my story, and I'll never forget that. And it cost me that agent who's now super successful, and I'm like,
Yeah. One of the things I like to tell people is this: at the end of the day, the people that we close transactions with remember how they feel, right? So emotionally, buying a house, financing real estate is a big decision.
Yep.
And the moment we forget that, I think we need to get out of the business, right? So let me explain from my personal experience.
Yeah.
Number one, we're asking for everything under the sun. We're like literally taking the hard underside shell of this turtle, and we're uncovering everything. Yep. And it's much better if you just tell us than later on for us to find it through discovery.
We will find it.
Yes, underwriters today and the background research and stuff that they do is unreal, right? And then when you call them on it, the clients, okay, talking to you, listeners and viewers, if we find it and we find it later, it could jeopardize the money that you've put up for deposit, and you may lose your inspection
money,
expenses.
Inspections.
So we don't want to practice, we want to close. If we are the one that closes the transaction, we're the hinge. If you don't help us, we're not going to close. But if you're thorough on the front end, you give us everything we ask for, it's going to be so much better for you. And we're not asking because we want more paperwork. Trust me, we've literally seen thousands of pages of bank statements every year.
Good, yeah.
And there's no need for us to dig any deeper than necessary. Yep. So please just help us help you. Help me. I feel like this is Jerry Maguire, right? Help me, help you.
Help you. Yeah.
So,
we are all about the path of least resistance. Yeah. All about it, right? And I'd rather collect that paperwork up front and just kind of have it on deck and only send in what's needed on my end.
Yep.
And then that way, maybe I don't have to come and ask you for it if they do ask for it later.
Yep. And that is just so key. And I think the better prepared you are, the easier and the smoother transition will be. And at the end of the day, you have enough to think about it. Let's just think about this. Dan, I know you've got children, you've got a wife, your house is under construction right now. Imagine that I told you
trying to buy a house right now. Yeah.
You had to move in 30 days.
You know what? I actually remember doing that, Alan.
Would you be ready to move in 30 days?
Yeah.
It's unreal. You're literally, I don't think my family would be. There's just too much stuff. I mean, I've carried stuff from house to house, and we've accumulated stuff. My dogs, they know every inch of my house, right? It's like, uprooting your family is a big deal. And if you miss timelines, it's a big deal. People take time off of work because they have to sometimes schedule in advance, right? They have to set up utilities. They have to set up all of those things to get their kids in school if they have children. They have a lot of moving parts. And this is the inconvenience part that nobody wants to talk about.
Right.
It's the unsexy stuff that we deal with. But
that's why I try to families. That's why I try to front load the paperwork as much as possible. Because 2-3 weeks into the escrow, like, your house is boxed up, man. You're not going to be like having the easiest time finding paperwork, especially if you're the manual paperwork type, right? Where you get your mail still, right? And you file away paperwork and stuff like that. Like, I mean, I don't want to make you go digging in, I've had plenty of clients have to go digging for things that, I'd rather not do that to them. Yeah.
Well, now that you said that, let's transition into what are more difficult borrowers to qualify. So give me an example of let's start with the easy. Let's start with what is a cookie cutter scenario, if you will, for a borrower that's probably the easiest ones to qualify. So just go through the basics.
Oh yeah. Easiest one to qualify is a W-2 employee, has a set, like I make, $65,000 a year. I know the exact yearly amount, and they've got, plenty of money in the bank. Pretty, and it's been there for a while. It's not immediately entering the account, last, 2 weeks ago.
Where'd this money come from? I don't know.
Yeah, those anti-money laundering laws, right?
Exactly.
So, those are the easiest ones for sure. The W-2 borrowers, right? The self-employed have gotten easier now that they've removed all the COVID overlays that we had for a little while there to make sure that people's self-employed businesses weren't slowly going into the hole because of COVID, right? They were worried about self-employed businesses much more then. A little less now, so we're back to normal there, thankfully. Because, man, that was rough for a little while. Woo! Yeah. We definitely made our money on those, man. I tell you, those were hard back then. But so that those are really the things that are the most cookie cutter is just, normal jobs, normal pay stubs, a non-variable income, right? Just they work their 80 hours every 2 weeks and everybody's happy.
So let's jump into a more challenging, because you brought up something right now. Let's talk about inconsistent income, variables, gaps of employment, things that, as I like to educate clients to understand, is that if you had $350,000 as your money to lend, and somebody's coming to the table and they're trying to borrow your money, would you be a little bit cautious in who you give the money to?
Maybe just a little bit.
Yeah. So I think people forget this, that a bank is not a person. It's an entity, if you will, that has an asset that it's wanting to lend out to collect interest and profit, right? Yeah. So I'm not jaded by this fact. We're in a business, and most people, unless it's truly a charity, are not working for free. So these banks are lending money to make a profit, but they're doing so with a very calculated risk. And that calculated risk comes in the form of underwriting guidelines. And literally, it is a person that reviews the written guidelines and validates every point. So in many ways, you and I are the first set of eyes on everything. So if it doesn't pass the sniff test, we're going to say, hey, what about this? Let's explain this, because I don't want to present it to the bank unless I know going in what we have to explain.
See, there again is why we need to know everything.
Yes, just tell us.
Because I have to represent you like your defense attorney to the underwriter.
Yeah, and unfortunately, when we get put in that defense mode, it's harder for us to dig ourselves out, because unbeknownst to most consumers out there, a bank does not have to give you the money, even if you meet the qualifying standards. They can actually feel like, no, there's something doesn't feel right. I'm going to stop here and I'm going to ask for a secondary review, and then they'll decline the file. It's very, very rare that it happens, but it can happen if the bank doesn't see that there's continuity of information within a file.
The bank has to have a sellable loan.
Yes.
Fannie Mae and Freddie Mac. Absolutely. They have to. Yeah. That's why the underwriters exist, is just simply to make sure that loan, they don't got to service it forever. They can send it off to Fannie Mae and get it sold, right? That's what they want. So the idea is to make sure that there's a sellable loan at the end of the transaction, right?
Yeah. And
so
another thing
that's what the underwriters are doing, is just making sure it's sellable.
Yeah. And that verification process is just paramount. So we want to get through that first. Once we have our conditional loan approval, I'm happy chasing conditions, but if you do a good job, it should be very minimal. It's like an updated pay stub, or, hey, document where this deposit came from. And then you're like, hey, look, I have the copy here, so, but those are the types of things that also develop trust, not only with your clients, but also your real estate agents, the other professionals you deal with. And as your name starts to get out in the public and they see, yes, when Dan sends out a pre-approval, that transaction will close, because they have confidence. Yeah. Yes. And those are the types of things that are very, very important. It allows us to represent those that we serve well, because guess what? We're only going to be able to serve other families they refer if we do something of value to them. Bottom line. There's no question.
We are 100% in the referral business, right? And Bakersfield is a small market. There are, word of mouth gets around. If you mess up,
I think it's 2 degrees of separation, man. I think it's like 1.5.
Yeah. Exactly. So, that word gets around. So really, our reputations are a big deal. And this is part of why, it's important to work with a good loan officer as well that has a good local reputation, because then your pre-qual letter has a good reputation behind it when you present it, right? Because that's something else that gets you higher in the stack, especially in that that supply and demand that we're heading into again, that kind of market, that helps you get higher in the stack, right? And obviously the cash on top is going to be helping you. The type of loan is going to help get you higher, right? But that loan officer on that pre-qual letter is important.
Yeah, absolutely. Let's go through a difficult scenario. Can I tell you the variable income? Because I just had a scenario like that about 3 weeks ago. So I had a gentleman come in, beautiful family. They, have a property. They want to buy an investment home. And they said, okay, well, we need to do this. So at first I'm thinking, well, the path of least resistance would be like a debt service coverage loan, like a DCSR, DSCR. And I thought, but the rates are they're horrible. Let's be honest. That's a plan B, maybe a plan C. But they had excellent credit. They had assets. The wife worked a W-2 job, very straightforward. Income was consistent for at least 5 years, right? So there was no question about it. The husband was a truck driver and left a company after working there for 7 years. Now, here was the thing.
Buzzword, truck driver. Yeah. I always am like, oh.
Yeah. You're like, oh, that's fine. Get more information, right? So I look at the pay stubs and it says commission. I'm like, commission, okay. So I know, hey, this may be something where they're being paid per load, right? So very common, but we have no track history. He'd been there for 5 months. So I told the borrowers, I said, listen, you have excellent credit, literally 805, 810 credit scores. Yeah. They have over 200,000 in the bank. Everything looks beautiful. Here's the thing that I didn't have was consistency and likely to continue. Yep. So I go back to the guidelines and I'm showing them, I'm like, listen, you need to have a 12-month history. That's preferred to have 2 years, but same industry. So I request verification of employment. But this particular company used a payroll service. So the actual employer was not the one listed on the actual, do you know what I'm talking about? So it's a third-party payroll service. So they go and do the verification request and nothing, like no response. Finally, I get a hold of Bar. I'm like, hey, can you just give me a contact? So I get the contact. Well, now the third party is verifying that that's the actual contact person because fraud is still alive. Dun. Really, like people are still committing fraud, right? Yeah. So they finally get a hold of the right person. They fill out this full verification of employment, and it clearly states on their commission income. Likely to continue, yes. His earnings year to date are about 30% higher than he was last year. But then I sent it to underwriting, and the underwriter says, no, we need to have the previous history to see if we can use this as an average. So I order a verification of previous employment. A week later, I get the verification employment. Guess what it shows? No commission. Base pay, overtime. I go back to the borrower and I tell him, I'm sorry, but I can't do this loan until you have 12 months history. And then it was like, I can't believe you. I borrowed money before. I said, but were you with the previous job? Yes. And I said, well, this is a different duck.
Well, and the way to explain that to people is we have to prove stability of income.
Key.
Stability is the key. Yeah. So that income is not long enough to show some sort of stability. That's the key. You have not been through all the seasonal adjustments for a long enough period of time to show any sort of stability. So the underwriter is tasked with making sure that you can pay this loan back. It's called the ability to repay rule, right? So they have to prove your ability to repay. That is on us now, right? Because of all the old stated loans, that stuff from back in the day, right? The wild, wild west, as we call it. But that's the thing is without the stability, you can't do it. So in that scenario, I would have asked too, hey, do you have a minimum amount of mileage that you will always have? Because then you could try at least to hopefully have a baseline if you can get an employer letter that says he will always get paid at least this much and his commissions should always be higher. Well, at least you could try to maybe get some sort of mid-level lower amount to qualify with potentially. I've made that happen before, but yeah, it's a scary situation.
Was not hearing it, man. I tried and I thought to myself, I'm like turning over every rock, But here's the thing. They already had a house. They were trying to buy an investment property. So they're in a unique situation where they don't need to take action, but obviously we want to do our best to help as many borrowers as possible. But here's the thing I did tell them. The moment that you hit the 12 months, which would be October of this year, let's revisit this because you should easily qualify, right? At that point, your debt ratios would be in a comfortable range. You should be able to use the cash flow of the property that you're purchasing. You should be able to do a lot of good things, but maybe just the door isn't open right now. And that's okay. Yeah. I mean, Dan, if you had clients come back to you after you've coached them up and you're like, hey, and then you see them come back a year and a half later and now they're ready.
I have one right now, in fact, that I could tell you.
And isn't that like something that brings you a lot of joy? It's like, hey, you stuck to the plan.
Absolutely.
And then you're sitting there in a position where now you can help them to execute.
Because the thing is Alan, you'll agree with me on this. we are not in the like squeeze a square peg through a round hole business. Like I'm not trying to make a loan happen for these people right now. The idea is to put it together when it's right.
Correct.
Right? When it's perfect for them. Because everybody has, 2, 3, 4 real estate transactions in their lifetime. I just want to be their guy for whenever that is. Right? So the idea is like, hey, if you're not ready right now and we go into credit repair, for example, yeah, I'll see you in 6 months. No problem. And we'll coach you all the way there too. We'll do some simulators. We'll work out how, what to pay down so that you're not paying anything down that doesn't move the needle enough. Right? There's all of those little things go in there, but it's all about coaching. It's all about, doing what's best for the client. I mean, we really do want to do that. That's the thing, whatever's best. If it means waiting, then great. I'm happy to do that. I'm not going to try to force a loan right now just because I need it or something. It's not about me, right? We help others and then we get helped. That's the way that I see it.
Yeah,
so and I know you agree. That's why we're doing this podcast together.
Yeah, it's like, if you can be the blessing, let's do it. But if you're the reason why they don't get the blessing, that's a little different. We're not there to do that. We're there to help you to make the best decision. So I'm going to transition to the final topic today because actually it's gone pretty quickly.
Yeah.
I want to talk about kind of what you're seeing in the marketplace and direction for where you see projections going. Because we've seen a lot of volatility. And the volatility, I think, caused a lot of people some angst and, moving forward. But you and I have studied very similar material, and sometimes I like to bounce ideas off of other professionals because I believe that steel sharpens steel. Yep. What are you hearing about potential changes in the market conditions as far as interest rates and then long-term visioning of what we are seeing in the markets for real estate locally?
Yeah, so we're seeing probably a 3% appreciation rate this year still. We are not going down. In fact, we are still going up just like we have for the last, what did Barry say the other day, 120 months or whatever. We've been constantly going up in appreciation for 120 months. We have just a little bit of softening right now, but like it's still going to be going up. The idea there too is especially if the rates come down, we're going to be going up. I mean, there are not enough homes for the amount of households. That's really the biggest issue is the amount of inventory is significantly lower than it should be because of the lack of building the last 10 years and just the sheer amount of the immigration that's been happening in our country. Like there's just a lot more people and not enough places for them to live. This is why rent is so high. This is why the projection is for the real estate values to keep going up. Now, especially if we head into a recession, recessions typically mean lower interest rates, right? And so historically, since the 60s, every time I think except once, we've had lower interest rates, and they've been either and then home prices have always been supported or still going up, even during a recession. So don't let that scare you. Don't let the media scare you. Those are just facts from many, many times in the past. History tends to repeat itself. So that's kind of what I've been telling people is, it's now is a good opportunity to get in and maybe be able to get a deal. Maybe be able to get in with an FHA loan, maybe be able to get some 2-1 buy down or a 3% seller concession, 2% seller concession, whatever. But now's the time where you can score some of those perks, some of those discounts, maybe get the house for $10,000 less than asking price, just depending on what it is. But now is the time to take advantage of those things because once the rates come back down, it's going to be back to 2020 and 2021. Where we were just moving with multiple offers, et cetera.
It was crazy. I mean, that was just, I think I aged myself by 10 years during that time frame.
Yeah.
Well, you brought up some points about the recessionary history. So I brought up this thread. It's basically a source from Freddie Mac that shows relative interest rates historically. So you and I were tiny, tiny babies when interest rates were over 17, 18% in 1978 to 1982. But this bandwidth that you see, these dark gray areas, represent recessionary periods. Now,
and everybody our parents' age reminds us about this fact.
Yeah, I know.
Every other day.
This, and
yeah. Oh, I know.
You're watching this, and you have children or grandchildren, help them get into a house. It'll be the smartest and the most valuable thing that you can do for them because wealth.
Generational wealth. You will start that snowball.
Yes, because of real estate. Now, here's what I want to show you, and this is kind of what we're talking about. So we did have a minor recession in the 2020 period because there was such a pullback in the economic growth and development. People learned that they could work from home, right? So we had that transition. But the last one, and the only one tied to real estate, was in 2008. But this all happened because of bad actors, bad loans. We had very poor qualifying standards. It was pretty much fog and mirror, get a loan. There was no guarantees. There was no protections. The mortgage insurance was non-existent. And then unemployment went crazy. So this recessionary period cannot be really compared to the last one and the ones prior, right?
Because we're not doing loans like that anymore. People are vetted. People can qualify for the loans they're getting now.
Yeah. But take a look at how the interest rates dropped. Now, one of the things that we did have during this time frame, specifically starting here and why we almost touched, 2.5%, 2% on 30-year rates was this. We had something under the CARES Act, basically the quantitative easing, but it was it was on supercharge, like some crazy amount of investment. I think stats showed 120 to 130 billion a month of mortgage-backed securities being purchased.
Yeah. So basically, for the viewers, quantitative easing means that the Fed was basically keeping the markets normalized, so they weren't just like going super, super crazy. Because believe me, when COVID started, it was crazy to watch how up and down, and you can't hedge against like 200 basis point swings on a daily basis.
It was
right.
It was crazy. So let's show them the graph here. So this is how we live our life. Literally at 6 a.m. every morning, it's going to be a good day or a bad day. Have you ever felt that way? You're like,
every day. And I try so hard. I'm like, I should not open MBS Highway in bed before I even get out of bed.
Yeah, and I kind of feel that way too. It's almost as if like it's going to start my day well or it's not. And then it's like, okay, something's got to give, right? And we've been watching these floors of support, and we're looking at the fundamentals. We're like, okay, it should happen. It's like, let it happen.
It's oversold. We gotta get
exactly right. So we need to turn. So here's what I'm going to show the viewers. So this is the key point. This is not normal, folks. This is very volatile. There's a lot of swings, okay? Now, the higher it trades, the lower the interest rate. The lower it trades, the higher the interest rate. Banks don't change their profit margins. Yeah, so it's just an inverse. So when we see this candle up here, you can see a significant differential here. This means lower interest rates. So here's the thing I want to show everybody. Let's look at the 2-year history.
Yeah.
Holy smokes. You see all this way up here. This is the reason why interest rates were so low. And we can't go past this, but there was a period of time that this was pretty stable. And then we had the announcement that they were going to start slowing the flow and the quantitative tightening that started to happen. And that happened on around November of 2021. And then we started to see this drop and this drop and this drop. And then,
and then 2022 was just like,
so emotionally,
stop it.
It got to a point where it was, you just didn't want to talk to somebody that day. But here's the thing I want to point out. And here's my example I use. I know I should take this off. This is all getting us all depressed, right? So here's the thing I try to explain to clients. The reason why it stayed so low for so long was that supplement. So for every dollar that was invested naturally in the market, we had $4 that the U.S. government through the Treasury Department was buying mortgage-backed securities. So it was like a supplement that once it was weaned off, the market was moving up and down because it had no stability, right? So I should give this example because I think it's the most relevant. For those people that have ever gone to work out at one of these nice, places that have these machines for pull-up bars. You ever seen these where you can actually add weight?
Oh, yeah.
So, you could put 100 pounds, and when you're pulling up, you're pulling out 100 pounds less, so you can actually do a pull-up. Then, your friend thinks they're cute. They pull that 100 pounds out, and you can't move it at all because you have
Right.
no leverage. You don't have that assist of an extra 100 pounds to make that pull up more manageable. That's the way this
exactly
market
what
works,
quantitative easing
right? So
is.
we did not have that benefit, and we've seen this kind of volatility. And when we see ranges of trading, we actually kind of get a little bit happy, but it's not been stable enough for us. We like to see stability, and consumers should understand that when it's the right time for you to buy and the door's open, buy. Let's not, because market will go up and market will go down. The only way that you know if the market is at its bottom is when you're going the other direction.
Yeah. But you see, that's the thing is when you got a, when you're trending towards the bottom, right? Most people aren't going to sense it until they're like partway back up the other
exactly
side.
It's when you hit the bottom,
the sellers get confident. That's
Yeah.
when the sellers get confident.
Yeah.
And you're like, oh no, I'm too late, right? But you got to buy up here, not over here.
Exactly.
Right?
Because you can't time the market. And that's the thing. Dan, if you and I honestly could time the market and we knew, the date and the time, we would be like, show up this date and time. There'd be a line out the door, down the block, and we would have to work maybe 3 days during the year, and then we would be done, literally.
Yep.
But I think our hearts are too big for that. We probably want to help more people. But it is literally one of those things that we wish we could do that. All we can do is use the data and our industry knowledge, the number of at-bats we've had, to give you the best advice that we know how. And understand real estate is very local. It is not something you can read on a national news wire because it doesn't represent our local economy. Because there are some markets that are suffering with much more extreme market corrections, but they're nowhere near the price points that we are. So that's a very important distinction. So that's pretty much all the detailed stuff that I wanted to go over. Is there anything that you want to cover or things that you think would be relevant for? We'll have you back on too, Dan. Don't worry about it. It's just
I mean,
is there anything that you think would be good to talk about?
I think the big thing is just, find a loan officer that you mesh well with and be upfront with them. Get the paperwork in as soon as you can. And the paperwork helps us to keep you safe.
Yeah.
Right? The paperwork, if I can vet that paperwork ahead of time and do more of a pre-approval versus a pre-qualification, right? That all the better, because then I can make sure that, I've alleviated roadblocks, right? I see more of a clear path down the road. And, getting that solidified up front and early is the best way to avoid, potentially me missing something, somebody missing something, right? Because it's all last minute or it's, 9:00 at night on a Saturday or whatever. Get in, get pre-qualified early, before you find the house you have to have, right? Don't be afraid of your loan officer. I mean, I don't know about you, Alan, but I only soft pull credit to start.
Yeah, same here.
That's the way the industry is going because credit reports have gotten outrageously expensive. So,
but it allows you to properly plan too, right? You and I know we can look at
everything I need.
And in literally a minute and a half, we're going to tell if that file's going to go or not go. But one thing I do encourage people to, if you're on a threshold, meaning you're at, say, 642, and you need a 640 for a program, we're going to do a hard pull. Why? Because we want to memorialize that date and time, right?
Correct.
But we're also going to coach you up and say, if many changes happen here, this could nullify everything we've worked towards. So please understand, don't do any new credit pulls. Don't apply for new credit. Don't run any balances up higher than these thresholds. Don't go over your limits. Provide yourself with breathing room and understand that if you're real close to the next threshold, let's say you're at, say, 658 and 660 is going to get you into a program, we're going to tell you, hey, today, if you have the money, go pay this balance down. Don't close the account. Pay the balance down and watch it closely because we're going to be wanting that pop. Once you hit that, you know how much more impactful that is for a client to know that that's possible? Because you've empowered them. You've given this key to say, hey, this can be better for you. Just follow my lead here. Allow me to walk you down this. I've listened to the song before. I know when that downbeat's coming, we're going to strike while the iron's hot. We're going to provide you with the most value. Now, I can't create the house that you're going to buy. So now your real estate professional, that real estate agent is our partner. I like to say that, and this is the way I see it, so I like to give examples. I'm sure you do too, is this. We're like the pharmacist and they're the doctor, right? So they write a prescription. We read this thing and go, did you mean to write that? That's going to kill the patient. right? And they're like,
Yeah.
right. And then,
Double.
so let's go back and rewrite this because they can't fulfill these terms, but I got them into contract. I'm like, great, but we can't close on it. Right. So it's very important that we communicate with our real estate agents, help them leverage, because if we're unified as a consumer sees us as a team, I believe that closing will mean more to them. It'll help them make better decisions. They can then confidently refer their friends and family. They're going to have success, and they're going to have something that is building their net worth over time. And it's literally can change. I can't tell you the number of times that the house took care of the family. They didn't see it that way when they bought it because it was a struggle.
Yeah.
But, 6 years into it, they're able to, number one, pay off debt that they weren't able to get out of. They're able to, remove mortgage insurance, lower their payment, now start saving. Because they before had no ability to save. They just didn't know how to do it. So in many ways,
right there, what a CMA does is
absolutely
taking all of that into consideration, right? Helping people with debt consolidation, helping people make better financial decisions, looking at it more than just this one transaction, but looking at the scheme of their life.
Correct.
Where is this taking them? What does the next transaction look like? How can we use this mortgage to benefit them in more ways than just the house?
Yep.
I mean, there's lots of things we can do.
And I think a lot of people, once you get into that point where you're actually comfortable with I call them the rhythms of finance. So when I'm examining somebody's bank statements and they say, oh, well, the payment's only $200 more. And I go back through their bank statements but you've not left yourself enough margin for $200 left over every month. So the next 3 months, I want you to save $200 and pay yourself. And if they can do that, then they know they can afford that payment difference. And you can take it to extreme. I've seen $1,000 increase over their current rent, right? But they want to invest themselves, so they do it and they squeeze. So it means that the biggest hole in most people's spending typically is eating out. Let's be perfectly honest, right? I can get out of most places with a family of 4 for less than $80, 65 on the cheap end. And that's if you don't order drinks. No apps, you're just like bare bones meal and tip. It's just, but that's the cost of living now, right? So, well, cool. Well, Dan, thank you so much for your time. It was great. I know that this is going to be value to a lot of people that I guess just having a casual conversation about finance. I don't know how more exciting we can make this stuff, but I'm glad you're along for the journey, buddy.
Yeah, 100%. And I'm just grateful that there's other like-minded folks out there that take care of people just the same. I know we're competitors, but we're friends. It doesn't matter.
Yeah,
there's plenty of business for both of us. And especially when you take care of people, there's always plenty of business for people.
For sure.
I'm just glad to be teamed up with you, taking care of the city of Bakersfield. So
absolutely.
Appreciate you, brother.
Absolutely.